It is time for us to start with lesson 14. And as usual, I need to remind you to take a few moments to pause the lesson and refresh your view of the disclaimer and read it and take another look at it. All right. In our last lesson, we had begun to take a look at how we would incorporate some technical analysis in addition to our profile concepts to help enhance our trading and increase perhaps our confidence level as we trade. We will continue to take a look at this process of integration in our lesson today. So we will talk more about the Keltner channel, and we're going to introduce another tool that is useful, especially in a sideways or a non-trend day or on neutral days. The tool is the stochastic, and more specifically, we're going to talk about a special form of the stochastic, which is not available on many platforms, but fortunately, it is available on Market Delta, and that's an unbound stochastic. Then we are going to cover three concepts that we need to be familiar with vis-a-vis the profile. We're going to talk a little bit about ledges, what they are and what they mean and what they tell us about the market. We're going to talk about the closing range, and we're going to look at what is described or what should be identified as a failed range extension. So we have some interesting things to cover, and let's go ahead and proceed with that. Let me come back and revisit the Keltner channel, and I will refresh your memory. The Keltner channel, again, is a band that is based on some standard deviation of a moving average. The Keltner that I like to use, and I'm going to recommend for you, is one that is based on the 20 moving average. And you will find that the 20 simple moving average is an important average in the market. Prices tend to interact to it vigorously. You will see that the market does not like to travel very far one way or the other from the 20 moving average, and always likes to come back and sort of test. If it moves too far away one way or the other, it has an inclination to come back to it. The same actually also holds true of the 50 moving average, but the 20 is a more immediate and seems to be more in interaction with price action as you observe the market. So that's why it is a good setting for the center line of the Keltner channel. Now, the default setting is usually one standard deviation. I recommend 2 standard deviations. This is a setting that you may have to revisit based on the type of instrument that you trade. And 2 standard deviations is a good setting for the ES Mini. And you will find that that will be, in my experience, I found it to be true for many other instruments as well. However, some instruments tend to stay closer to the 20 simple moving average and don't deviate that much from it. So you may want to go to either a 1 standard deviation or 1.5. And you will find that there will also be some instruments that are very volatile and go as far out as 3 standard deviations, sometimes even 4. Those are very volatile types of instruments to trade. Now let's talk a little bit about the bands themselves. So we have a moving average as our center line that's surrounded by a band to the top of it, as well as another band to the lower side of this center line. And I want to draw your attention to the width of the band itself, the distance between the upper band and the lower band. Of course, the center line really is our blue line because that's the same as our 20 simple moving average. When you get directional markets, you're going to find that you are going to have a rather wide band for the Keltner. So that's always an indication that there is a directional market when you see these bands expanding and widening. They never quite widen like a Bollinger, but nevertheless, you will see that they will appear wider in directional markets. And interestingly enough, in directional markets, you will also tend to see prices on one side of the Keltner, not really moving up and down within the Keltner, but up to one side or down to the other side. Now take a look at how the Keltner narrows when we have a non-directional or a non-trending market. And this is one feature that just visually helps you right away by looking at the Keltner to sort of see what the market is doing. Is it in fact trending, or do we have narrow bands, and are we in a sideways market? All right, I'm going to begin by taking a look at a split profile, and I always like you to look at these split profiles, because when we begin to look at the bars and apply the Keltner to it, I want you to sort of visualize or have an image in your mind about what the profile looked like before we begin looking at the bars themselves. So this profile, we had more TPOs on the top side, and we didn't really have a directional day. This is non-directional, but where value or balance was more towards the upside. So let's take a look at this day in the bar format, in the footprint bar format, and sure enough, notice how the top of the day was pretty much a consolidation, and the lower portion of the day was really another consolidation. So the day broke up into two parts. Now take a look at the Keltner. And notice again, as a result of the width of the band, you could see that this is a directional market. But this is not the only telltale. Even though this was not a very strong directional market, that we still had some movement to the upside in the market. Another telltale sign that I want you to quickly learn to identify is the slope of the center line. Notice how this is sloping upwards. The upper Keltner is always an important line to also identify, and take a look at where prices are relative to the upper Keltner. In this case, this was not a strong directional market. It did have some directional bias. I can see the blue line, my center line, heading up, and I also see the 8 simple moving average heading up. But prices are trapped in this upper half of the Keltner. So right away, this tells me that even though I have a directional move, I should not be expecting too much out of it. We're not really going to go very far with the movement. If in fact the prices are heading to the upside and they're trading outside the Keltner channel, that is certainly a more powerful move to the upside, and my expectations would be a little bit greater from a move of that type. So what I'm trying to get you to learn to do is discern or extract information about the market simply by looking at where price is relative to the Keltner channel. And this is really a matter of practice. The more you look at the market, look at where price is and sort of what is it doing vis-a-vis the Keltner, you begin to develop these skills, and eventually, hopefully, they become second nature to you. Once again, here's our 8 simple moving average. Now I'm starting to sort of blend a couple of technical analysis pieces together. We have the Keltner, we also have the 8 simple moving average, again, the center line, and of course the lower Keltner. Now let's take a look at adding another interesting piece to our chart, and that is the value area high and the value area low. And by the way, there is an indicator in market delta that will allow us to do that, to add the value area high and the value area low on the footprint bar chart or on a candlestick chart for that matter. Not only that, it will also allow you to add the POC. Not only that, it will allow you can have, if you want it, the current day's value area low and the value area high and the POC and the prior day. And as we've learned from our prior lessons, that relationship is very important to look at to see where price is relative to the prior day's value area. So this is another element that I would recommend that you would have on the chart, so you can always see where your value area is for the day relative to the prior day, and you can also see the footprint bar within, whether it's within the value area or outside the value area, and it gives you an immediate idea about what is happening in the market vis-a-vis the value areas as well. So even though the charts begin to look a little bit noisy, they do give you a lot of information, and we're not going to try to clutter them anymore beyond that. So now let's take a look at how all of these things that we've added to our chart actually begin to help us to do two things. One, to identify trading entries, and two, to guide us as to where our targets are and where our stops should be. Let's begin with this basic trading strategy, and we start out by identifying an indication that prices are going to turn around. Now, you may choose to take the entry right here at this point, or you can take the entry when in fact price comes back to test this level again. But the one thing that I want to highlight for you to train your eye to spot very quickly, take a look. When you have a bar with a lot of red and it is a fairly wide range bar, and then all of a sudden towards the bottom of the range of that bar you see high volume, and all of a sudden the red turns to green. This is an indication that in fact prices are going to change direction and another time frame buyer has stepped into the market. So if prices drop a little bit lower, and sometimes they do, you may want to see this as a buying opportunity and buy a little bit lower. For our purposes and our discussion and demonstrating this strategy, we're going to assume that we are going to pick it up right at this price here, and certainly we had another chance when the price came back to test in the next half hour. So let's begin our entry at 1325. The next key question would be, where would we want our stop? Well, in this case, I'm going to use the Keltner to help me out with the stop. The center line is right here, and I take a look on my scale, my price scale, and this is at about 1323.25. And so I now begin to use the center line of the Keltner as a point for my stop. If in fact prices continue to move lower than that, then the market conditions that I was basing my trade on have changed, and I probably want to be out of the market. However, if the market continues to move in the direction that I had anticipated, I should be in good shape. Whenever you see, another important tip that I want to share with you, whenever you see the center line sloping upwards like this, do not think shorts. Always think longs. Okay, you want to be in the direction of the market. This is where the Keltner helps you again. Look at this. The upper Keltner is headed up. The center line is also headed up. And the lower Keltner is up. It's almost as if you have directions on the highway saying up, up, up. Do not take shorts, even though you have a big red candle here and so on. So that's why the minute that I begin to see buying volume moving into the market, I begin to recognize that we are at a transition point. Things are going to change. And sure enough, many traders will then begin to buy when they see that the POC for volume has jumped up, and they get into the trade up earlier. I don't want to give up all this profit simply for the confirmation of the volume POC. And yes, of course, when you see a big jump like this in volume POC, that's also another strong indication that in fact the market is going to move up and continue moving up. So there is a little bit of a risk, but I protect myself with the stop down here. All right. The next thing that I want to look at is, where is my target? And whenever I have a non-trending day like this, and again, we already identified it early by indicating that the movement is not going to be very strong. I'm not going to see a huge price spike because this is not a directional day. So the gains that I would be looking at would be somewhat limited, and I need to recognize that. This is where learning and understanding the type of structure and the type of day that we're in really helps. It makes you pick reasonable targets and targets that are in line with the nature of the market structure that's developing. So I would put my target at the POC. And sure enough, prices do come up to the POC, and even if you had picked it up here when you saw the volume POC move higher, you would have still had a little bit of profit to the POC. But look at the difference. Once you see this signal here and you enter here, you have more money that you can pick by the time it gets to the POC. Here, you're picking it up below the value area, the low value area high. You're also picking it up close to the center Keltner. So there are a number of things that tell you, and you also, of course, see big volume moving in, changing the red to green. So you have a number of things that should help encourage you to take a trade like that. Now, the next thing we look at in terms of our next target is the top value area. If, in fact, the next level that we are likely to reach as a target is the upper high value area for the day, and this would be this level here. And the next target that we would get to, and this is sort of very optimistic now, is if in fact we could reach the outer Keltner. And if you notice, we did in fact reach it, but it wasn't till the close of the day. So you can see in these non-trending days, it is difficult to get very many points out of the market. And that's why the directional days are the ones that typically give us the best opportunities in the market. Now, to re-emphasize, I stayed away from any shorts on this day. Some traders might say, well, I see a resistance level developing here, I will take a short. Fine. Even if you were able to take it at the very high, your gains are minimal at any point. It just does not move too far to the downside, and the 8 simple moving average seems to be hugging it from below. The market wants to go up, so it is more prudent to go up with it. Take the low-hanging fruit. Stay away from these uphill trades that require sort of more risk, and you're moving against the trend, moving against the tide. And this is why we want to use these tools to sort of help us to keep us in the right direction. So before you take any trade, always take a look at your 20 moving average. What kind of a slope does it have? Is it sloping up or is it sloping down? If it's sloping up, always remember, Kepler told me stay in the direction of the trend. And I begin to look for long entries and only long entries. Those will have the higher probability of success because I'm moving with the direction of the wind and I'm not moving against the direction of the market. And by the way, this is a very important skill to develop. People get carried away and they sort of neglect the big picture and focus on a 1 or 2 tick gain without realizing that the odds may not be in their favor. All right, I'm going to switch gears and take a look at another simple strategy that we could use. And once again, I am always staying on the right side of the market, staying long. So when I see a day like this developing early in the day, here's my simple moving average heading up, I'm only thinking long. So if I don't take this trade and I continue to watch the market and I see now that prices have made it above the 8 simple moving average, and every time they come to the 8, they move back up again. Okay, well, then I wait for it at the 8 simple moving average, and I just take little entries at the 8. Buy here, buy here, buy here, buy here, and then take it up for perhaps 2 or 3 ticks. These are scalping strategies. They're not going to make you a lot of money, but they will at least give you some trading opportunities when the market is not directional, and you need to at least be aware that they're out there. Each person will need to pick the opportunities that they want and the type of risk-reward ratios that they seek. My job is to teach you the different types of opportunities that present themselves in the market and then allow you to choose them. All right, now I am going to switch time frames. We were looking at a half-hour market, and now whenever we get into a very tight sideways market, this is when we take the time frame lower. So now we go to 5-minute bars, and we use the Keltner to help us again decide on where to trade and how to trade. And you can see that it really helps contain the price movement for us on the 5-minute chart. And we can see here we have a flat 20 moving average. Sometimes some people choose to completely stay out of the market when the 20 moving average is flat on the 5-minute chart. Others will then say, no, I'm going to take a look at the Keltner, and anytime prices drop to the low Keltner, I'm going to buy. And some of them even go as far as anytime it comes close to the top, I will sell. In this case, because you're really in a completely sideways movement, you may want to take some of the shorts as well if they come close to the top of the Keltner. And basically, the pattern of trading becomes just sell the top, buy the bottom, sell the top, buy the bottom. You want to be long at the low Keltner down here. Put a stop 2 ticks below the low Keltner. Never go with wide stops on these Keltner moves. Target at 4 ticks or the center line. So if you're starting down here, your target is going to be the center line. If you're starting from up here, once again, your target is the center line. And here in this type of trading, you're not looking for target 1, target 2. There's no direction. There's really no momentum in the market. These are minuscule, tiny trades, and you have to recognize them for what they are and trade them accordingly. Don't expect much of a market that has a flat 20 simple moving average. This is a 2, 3 tick, 4 tick tops is what you're going to get. And quite often for beginners, I would say, unless you've really practiced this technique a lot on paper trading, stay out. Sometimes it's better to be out than it is to be in. Go in when the market has some momentum and direction. Step in with that momentum and direction and capture some nice gains. All right. Now I want to introduce a different type of indicator. And this indicator seems to work, the stochastic is the one that we're going to talk about. It works far better in sideways markets and also with shorter time frames. So let's take a look at this stochastic and learn a little bit about it. It is a very popular indicator, as a matter of fact, on many platforms. We have one feature in Market Delta that you will not find on stochastics in other platforms, and that is it is going to be an unbound stochastic, and I will tell you why that is a valuable and important feature. But let's first look at the logic of the stochastic, what it does and how it helps us. The stochastic is basically based on the idea or the observation that as prices increase, closing prices tend to be closer to the upper end of a price range. And in downtrends, the closing price tends to be in the lower range. Let's explain this a little bit more. If I have a bar and the market is moving upwards, we have a directional move, then the bar will close towards the upper range of that bar. And that makes a lot of sense. I also want you to take this principle to heart because it comes into play very often in the market. You always want to look at, especially when you get a wide range bar, at about 50% of the range of the bar, and compare the new bar to how far down it comes to the 50% of the range, or if in fact the bar is coming up from below, what level of penetration it penetrates in the lower half. Once you cross the half point one way or the other, we identify this as sort of a tilt in the critical mass. Now there is a greater likelihood that we may in fact be able to continue moving upwards. So the range and where price is in the range tells us a lot about sentiment in the market. And that's the principle that the stochastic works on, and that's why it is often useful. So by the same token, if in fact the price closes at the lower end of the range, then obviously the market wants to move lower. All right, let's take a look at how the stochastic processes this information and makes it useful for us. The idea that if in fact the market is moving lower, it will tend to close towards the low end of the bar. If the market is moving higher, the close price is going to be towards the top of the bar or the high end of the bar. The stochastic basically has two lines. Some stochastics also have a third line. Let's focus on keeping things simple. So we have a fast and a slow line, and the intent of the stochastic process really is to determine where the most recent closing price is in relation to the price range for a chosen time period. And typically the time period that the stochastic is set for is 14 time periods, even though our stochastic in Market Delta is set at 15. 14 is what you will typically find on 90% of the platforms out there. 14 or 15 does not really make that much of a difference, so I would leave the setting at 15 in Market Delta. But at least recognize that this is the default, or if you see 14 somewhere else, you will know that this is how the line is calculated. It takes a look at the last close of the period and the lowest low for the last 14 periods, the highest high, and it subtracts from it the lowest low, and then it multiplies it by 100 to get a percentage. This is the traditional stochastic formula. The unbound stochastic doesn't really limit it to just 100. It allows us to go above 100. Now let's begin by just taking a look at how we get the stochastic on our chart. And once again, we pull up our indicator window using the insert button and hit S to get the stochastic from the column here. So if you click on the S, you'll get the indicators that start with the letter S. Pick stochastic. Once you have the stochastic, you will get this window. And here are a couple of adjustments I would like you to make to the default settings. You're going to select the unbound. So we want to use the unbound stochastic, and I will explain to you why and what that is. The period here, as I told you, the default is 15. If you want to change it to 14, I'm fine with that. 15 is fine as well. We want to use the fast %D and the slow %D. These will be the two lines that we will use. And then for my low reference point, I like 20, and for the high reference point, put 80. The defaults in market delta, I believe, are 25 and 75, so you would need to adjust and change those. Now, once we have all of our settings in place, we're going to get a stochastic with two lines and two reference lines. The reference lines are the 25 and 75. This one has the default settings on it. The blue line is the fast stochastic, and the red line is the slow stochastic. Now, let me begin to show you how we use the stochastic to help us with entries. First of all, we begin to identify a transition point, and then we look to the stochastic to see where it is. So once again, we begin with our market profile concepts. And here, what I've begun to see are two things that we've learned so far. One, green is appearing where red used to be. I also have an expansion of the range to the upside. Not a very big expansion, but a little bit of an expansion. So I have a potential entry here, okay? I've identified that by looking at the bars. So the market profile concepts help me to identify an entry. Now, let's take a look at some of our other technical indicators, and more specifically, we're going to focus on the stochastic and see how it helps us. All right, we talked about the green bars, and we talked about the range extension. All right, the first technical indicator that we already know about is the Keltner. And where is it relative to the Keltner? Well, first of all, what is the slope of the center line of the Keltner? And the slope is really somewhat to the downside, but it looks more like a flat market, not much of a slope. So it is a sideways market, and I have an entry that's well below the Keltner. I would be thinking, since this is a sideways market, of a long entry at this point. And this is where I would look at the stochastic to sort of reaffirm my thinking. The first thing I look at is, where is the stochastic relative to the two reference lines? If in fact the stochastic is below the lower reference line, then that is telling me that the market is oversold and that in fact it may be a good time to buy. Now, if we look at it here, and I want to take a long, is in fact the stochastic below the low reference line? And it is. So it reaffirms to me at least that the proper entry at this point would be a long, and certainly I should not be thinking about a short. Now, moving right along, let's take a look at what is happening to the actual stochastic line coming up from below. Have we started to see some closings towards the high end of the range? And are we in fact starting to get a little movement in the market to the upside? And once again, the stochastic affirms that for us. It's heading up towards the upside. So these all would be indications that would support an entry at this point. By the same token, if I were to come over here, and since I'm in a narrow range, look at how narrow this range is of the Keltner. And if I wanted to take a short at this point from the top of the range, I'm close to the top of the range. I'm starting to get a buildup of red, and the stochastic is up here high towards the top reference line. This would be another indicator that reaffirms, yes, there's a good chance things will move to the downside. However, since I am not above the top reference line, it is not that great of a signal. The higher I am above the top reference line, the better the affirmation or the confirmation. Now, markets are not perfect, and you don't always get these very high highs up here and so on. And sometimes also frequently you will see the stochastic move up and then down, up and then down here in the range before it starts really climbing to the upside. But nevertheless, at least you know that generally speaking, the market, when it's way down here, is really in an oversold condition, and that this is when the buying opportunities begin to surface. However, be very, very careful with the stochastic in directional markets. The stochastic is a good tool if your market is moving sideways. If you get into directional markets, quite often the stochastic can be very misleading, because it will stay either above the reference line for a very long time, and it will continue to go higher and go up, or it will stay, if the market is trending lower, down here, making you think there are buying opportunities, whereas it will continue to drop with prices, and it just stays flat down here for a very long period of time. So the only time I want you to pull out the stochastic and look at it is when, in fact, you are in a sideways market. This is when it becomes helpful. Now, the unbound and bound feature. Bound stochastics can only go up to 100 on the scale. An unbound stochastic, like the one that Market Delta features, will allow you to go as high up as it wants. And this is very nice in a way, because it doesn't restrict my stochastic, and it gives it freedom to move up as much as it wants. The same thing on the top side as well as the bottom side. So it acts as a filter for me, weeding out many bad signals or bad readings that I would get from a bound stochastic. I would not get those on the unbound stochastic. So that's why I like the unbound feature. All right, we're going to now switch gears and leave our technical indicators. Hopefully you now have a little bit of a feel for how to use these in tandem, in conjunction with some of the market profile concepts. And we're going to return to some market profile concepts and talk about those a little bit more. And we're going to begin talking about a ledge. A ledge is a profile formation. It's a very simple one of TPOs that looks like a flat line, and it seems as if somebody came at the normal distribution and chopped it off. And the best way to really describe it is by understanding what is happening in the market that makes a ledge occur. And I will show you, of course, a chart with a ledge in just one moment. The ledge is often the result of long liquidation. In other words, people who have long positions that want to get out of them, so they're selling, or it could in fact be the opposite, short covering. Shorts that want to cover their positions and get out of the market. So the market seems to move in one direction and then it stalls. There's no conviction or follow through in the market when you see a ledge. So let's take a look at how and when these ledges appear. We have two consecutive ledges here. Take a look. Prices came up to here and started to form a ledge. We have a low ledge down here, and we have another ledge up here. Now, this is on the 30-minute profile. And basically what this is telling me when I begin to see this is that prices in this area are, we have people that are liquidating positions and we have some that are covering. We're starting to develop a balance, or we're going to be trading in a range. So when I begin to see this on the shorter time frame, this is what it's telling me. Now I want to show you an actual video of how these ledges develop so you have an idea. Let's watch this together. Okay, watch this day. We opened within value, and then we get a little bit of a range extension, and we extend to the upside, and then we come back down, and we make a new low, come back with period D, and if you haven't already discerned, this is developing what is known as a neutral day. Okay, the beginning of a ledge here, F and G. Now notice FGH, we have, here, let me stop. Okay, here's a ledge. So when you see this, what this is telling me is when we get to this point, somebody is selling. We're getting some selling at this level. Now let's see what continues to happen. Okay, makes prices drop back down. This is a ledge at the top. Okay, we were able to break through the ledge to the upside. And we closed above the ledge. This is a telltale sign for you. When you see this happen on a neutral day, many people make the mistake of thinking, wow, we're going to shoot higher tomorrow because we closed towards the end of the day. But because of this ledge, you should be mindful that there was some selling during the day at this level, and the market was having trouble piercing through this level. And if in fact the other time frame seller allowed the market to go higher only in the last half hour at the closing range, this could be very misleading and very deceptive. So be very careful of this type of ledge formation. This traps a lot of people into taking longs at the end of the day, the amateurs, thinking, wow, the market shot up at the end of the day. Boy, it's going to skyrocket tomorrow. And sure enough, the next day opens lower. So this is one of the common traps that you will see in the market that you need to keep an eye out for. And so you need to be familiar with the ledge when it forms and understand the ramifications of it when it happens. Now, when we get a ledge, there are really two possible outcomes that could, in fact, take place in the market. We could have lack of continuation up, as the example that we just saw. The price would get to a point and stall. Why is it stalling at that point? Because sellers stepped in and pushed prices lower than the ledge. It's showing me strong resistance. By the same token, a ledge could also be a level of support. If in fact, every time price drops to a certain level, the buyer steps in and supports the prices at that point. Often what will happen is a break one way or the other. If in fact the support holds, the prices will break to the upside. If in fact the support does not hold, the prices will break to the downside. So expect a break one way or the other when you see these ledges. The reason that I want to highlight them for you, especially when they occur at the end of the day, is don't get carried away thinking that I would take a long position overnight because the market closed higher after it had been at a ledge for 4 or 5 consecutive periods, as we saw in the prior profile. Okay, let's now switch gears a little bit and talk about the closing range. Our closing range is basically the very last period of the day. And it is important in a number of different aspects. There are a number of reasons that make it important. Because one, it can have implications for the following day, and it also is a forcing point. And let me talk a little bit about what we mean by that. At the end of the day, in that last half hour, a lot of decisions have to be made. And you have no choice. The market is going to close in half an hour, so the decisions are forced on you. The close is, in fact, the last chance for the other time frame trader to decide what they're going to do. And they often have an idea about what they want to do vis-a-vis market direction. So they can decide to establish some new positions at the end of the day that they will then capitalize on the following day. So now they are deciding what they're going to do. And as you saw, what they really decided to do is to throw some money at it and then sell the market at the end of the day, bring it high, and then sell it from that high level. And as they sell, they bring the market back lower again, but everybody else thinks it's time for me to buy. And so they attract a lot of buyers in the market simply by bringing him in at that high. So some of the actions are misleading. They're not easy to interpret. And you have to be careful at the end of the day. You will also find something else very interesting happen right at the close, towards the end of the day, in those last perhaps 1 minute or 2 minutes of market close. There are deals that are cut during the day, and the transactions will only take place in the last minute of trading. This happens very often with equities and the ES Mini and so on. The transactions are of very large magnitude and will have a big influence on the market. And so the other time frame buyer negotiates with the market makers, and they know that they're going to introduce this transaction at this point, and it's going to have an influence on the market, and it happens right before the close, so that no one else has the ability to really take advantage of it or know about the move. So if you ever take a look at the time and sales report, you will always see huge quantities traded in the last 30 seconds, in the last 40 seconds, just before the market closes. There's nothing we can really do about this. I just want to make you aware of it, and so you can look for it and watch at the end of the day and try to see, well, what are they really trying to do here and what's going on. But we can take it from the open and then begin to analyze rather than making things difficult, trying to second guess at the end of the day. The close is also the last chance for short-term traders to balance their positions and flatten their positions for the day. So if a short-term trader is too long, they may want to be selling. If they're too short, they may want to be buying. So you get a flurry of activity at the close. The problem is it then makes it very difficult, because you're getting all of these forced decisions to really get a good clue about what's going to happen in the market. A couple of things that you want to look at are the extent of the range of the closing range. Did we have a real wide closing range, or did we have a tiny, narrow closing range? A tiny, narrow closing range indicates that there's really no directional conviction. No one is really trying to send a message to the market one way or the other. Once you begin to see very big volatile ranges at the end of the day, those should be cause for concern, more so than trying to follow in the footsteps or anticipate, because the players that cause these long tails or these big closing ranges are not amateurs. They're doing them intentionally, and quite often it's to mislead rather than lead. So be very careful when you see those. Sometimes after hours market activity will give us some clues about the intentions for the next day, especially if we get a strong directional move with high volume at the close. This may indicate that the other time frame buyer or seller wants to influence the market one way or the other. But because it came right at the close and the market didn't have time to react to it, it's hard to say. Is there a responsive buyer that's going to step in? What is really going to happen? You are then put in a position of trying to predict. And whenever you try to do that in the market, you really take on an undue amount of risk. So you want the market to tell you what it's doing rather than you trying to predict. And so I often find that, okay, I look at what happens at the close, but I don't try to predict. I just keep it in mind for the open of the next day and see how the market reacts to what happened the prior day. And certainly a very simple thing that you look at is, where is the new day's open relative to the prior day's close? And we've already talked about that several times. And we also take a look at where is that open relative to the entire prior day's range. So the close factors into what is happening for the next day's open, but I don't want to ever use it to try to predict. All right, the last topic that we want to tackle together in our lesson today is a failed range extension. Now, a failed range extension could surface or appear on a profile chart in a number of different ways. It could be simply just a single print. It could be 2 to 4 single prints. It could be a double print at the top or at the bottom of a range. So there isn't one single form that a failed range gives me, but basically what is happening with a failed range extension is the market tried to move and extend in a particular direction and it failed. All right, the important thing is, what is the implication of that? What does that really mean? Well, guess what? The market's going to turn back around and try to test the other direction. So failed range extensions are very important to recognize, because they tell me if the market failed in this direction, it is probably going to start moving and testing in the opposite direction. If then it finds support in the opposite direction, it will come back and test again where it failed before. It doesn't immediately give up. But if it tests on one end and starts failing, okay, well, let's test then. Do we really have, if it was trying to go up and every time it was trying to extend up, it couldn't do it, then it goes back and says, well, wait a minute, let me go back and check my support and see that I have the support that I need. And it goes back. If it finds the support, it then becomes bolder and comes back again and attacks the same resistance level that made the original failed range extension. All right. Basically, a failed range extension is telling us there is no follow-through after the initial attempt at range extension. In other words, somebody was trying to push prices one way or the other. They didn't have the conviction. And so as soon as they were met with some sort of responsive behavior, they really abandoned the scene. They were nowhere to be found. And so the range did not extend because no one really had the stamina, the wherewithal, the conviction to continue with the range in that direction at that point of time, or at that point in time. Let's take a look at a failed range extension here. And this failed range extension really was to the downside. We came down with column B, and then all of a sudden we got to this level. And what happens? We couldn't extend the range anymore beyond 13, 22, 25. What does that mean? Well, as a profile trader, I know that what happened here is prices dropped, and when they dropped to this level, a responsive buyer stepped in and started buying. And when the responsive buyer stepped in, prices did not drop any lower, because if I take a look at C period, here's what happened. C period opened at the low of period B. Again, it dropped one print to the same low of the prior period B, but was not able to penetrate or record a single print below that level. So obviously the responsive buyer responded again and picked up prices, and look at what they did with them. They moved prices in the C period all the way up back to the point of control. And if you notice, C printed one print right above the point of control. All right, then what happened with period D? Well, obviously in period C we dropped back a little bit more, and period D opened right here. So we were in the lower portion of the value area, and period D took us higher. Now, because the market failed down here and we were not able to extend the range to the downside, let's see if period D is going to try and test and see if we could extend the range to the upside. Sure enough, period D comes along and they try to move prices higher and higher and higher. We go past yesterday's low value area, but we're struck down at D period with the value high for the day. So now D drops back down, E opens up here near the high. So now we are beyond the critical mass point. We are now trading in the top range of the day. Piercing or extending the range to the other side is now a goal that we're going to try to see if we could achieve. And sure enough, E period starts to move a little bit higher, but doesn't get very far. And once again, we're stumped, or the resistance is at the day's value area high. We then begin with F period. And since we couldn't penetrate and go any higher with D, E, or F, what happens now is we start to move lower with F. And the same thing with H. H sort of falters around the middle point. We have not been able to break higher until we get to I period. And I period, in fact, manages to penetrate all the way up to here, but we still are meeting resistance at the top. When we cannot penetrate and we cannot extend the top, what do? We rotate, we come back around and try to extend the range to the downside. And sure enough, once again, we're met with the responsive buyer. So what we have here is a responsive buyer at the bottom and a responsive seller at the top. And both, the end result is we are trapped in this range for the day, and we don't get a range extension one way or the other. And that keeps us within that range. But what you need to recognize is that when a range extension fails on one end, the market then tries to go back and test it at the other end. If it fails on this end, it comes back again and tries to test on this end. And that is the rotation of the auction market. And these are that's what a failed range extension looks like. And also, if you remember from our discussion, it also looks like a ledge. A ledge has formed right here at the low. Now, some of these patterns develop and evolve as the market profile is developing. So we should be able to detect them not after the profile is completely finished. We need to also be able to see these patterns as they develop during the day, because they give us some insight as to what is likely to happen. So when I see that B and C both fail to extend the range down here, I should now know that prices are going to go quite a bit higher, and there is a very high probability we're going to try to go up and test the highs of the day. The range is going to move up. I don't need to wait for the entire day to finish to be able to discern that bit of information. The sooner that I'm able to get an idea about the structure that's developing and the type of rotations that are likely to occur during the day, the more opportunities I'm able to capture. And I know that this takes a little bit of time to grasp and to experiment with, and that's why I encourage you, when you, after each lesson that you take, to try to apply these concepts in real time, in the live market. It's one thing to look at things after they've happened and after the fact as historical, but it is also another skill to be able to identify them in the live market and to learn to capitalize on them. All right, and on that note, I will conclude our class for today.